Every day, millions of us buy a $5 coffee that disappears in 10 minutes. But what if that same $5 started paying you back $10,000 every single month for all of your retirement life? Sounds impossible, but it can. And you don't need to be rich, lucky, or even good at picking stocks. You just need to build the right system once. In this video, I'm going to show you and John exactly how to do that in 5 simple steps. We'll start real simple, learning what dividends really are, how they grow your income, and how to pick a few solid ETFs and stocks that pay you reliably. Then, I'll walk you through the full step-by-step plan, how to build a 5-asset dividend portfolio, automate it with dollar cost averaging, and in the end, I'll show you how that tiny $5 daily habit could grow into a $1.2 million portfolio that pays over $10,000 a month in dividends. But before we start building, let's make sure we're on the same page about what a dividend actually is. The first step in investing is know what you're getting into. Think of it like this. When you own shares of a company, you own a slice of that business. So when that business earns money, it can share a piece of that profit with you, and that payment is called a dividend. The return you get from those payments is often described as a yield. It's just a percentage showing how much income you earn compared to what you paid. So if you bought a share for $100 and received $4 in a year, that's a 4% yield. But the real secret isn't just how big that number is, it's how often it grows. Companies that steadily raise their dividends are the ones that quietly build wealth for investors. Think of it like getting a small raise every year at work, except this time it's your money getting promoted, not you. Those tiny raises compound, and over time they become a second income stream you didn't have to hustle for. More on that later. Before building a portfolio, it helps to define what you actually want from it. Maybe you want a few $100s a month to cover groceries, or maybe you just like the idea of earning income while you sleep. Whatever the goal, put a number to it, even if it's small. Goals give your money a direction. Now, once you know where you're headed, the next question is how to get there without stressing about timing. That's where something called dollar cost averaging comes in, or as I like to call it, the peace of mind method. Instead of trying to guess the perfect moment to buy, you invest a set amount on a regular schedule, daily, weekly, or monthly, whatever works for you. Some days the market is up, some days it's down, but your consistent, regular contributions smooth out the bumps. You end up buying more shares when prices are low and fewer when they're high, automatically averaging your cost over time. It's the same principle as putting a little money into a savings jar every year. At first, it doesn't look like much, but months later, you're surprised at how far those little deposits have gone. And here's the best part, you don't need to start big. You just need to start. Small, consistent investing builds habits, and habits build results. Also, one more important thing. Before you jump in, make sure your financial basics are covered. A small emergency cushion so you're never forced to sell, a plan for any high-interest debt you may have right now, and a clear sense of your why. Once those are in place, you can start your dividend investing journey. Now that you understand what dividends are and why consistency matters, let's get your system ready. Think of this step like setting up a bank account for your future paychecks. You're creating a place where all those dividend payments will land, reinvest, and grow. First, you'll need a brokerage account. That's basically your control center for buying and holding investments. There are tons of good options out there, and most let you open an account online in just a few minutes. When you sign up, you'll usually get 2 main choices: a taxable account, which is flexible and easy to access, or a retirement account, which can come with tax advantages but limits how soon you can withdraw your money. You don't need to overthink this right now. What really matters is just getting started. Once the account is open, connect it to your bank and set up automatic transfers. You can decide how much you want to invest. It could be daily, weekly, or monthly, and that money will flow into your investing account like clockwork. Automation removes the need for willpower. You never have to remember to be good with money. The system does it all for you. When you're ready to buy your first investments, there are two small settings that make a huge difference: fractional shares and DRIP, which stands for Dividend Reinvestment Plan. Let's start with fractional shares. Normally, if a stock costs $100 a share, you'll need at least $100 to buy one full share. But with fractional shares, you can invest any amount you want, even a few dollars, and the platform automatically gives you that fraction of a share. So if you invest $10 into a $100 stock, you own 0.1 shares. That means your full $10 is working for you instead of sitting on the sidelines. It's a small thing, but over months and years, it makes every dollar count. Now, once those investments start paying dividends, that's where the DRIP or Dividend Reinvestment Plan comes in. Let's walk through a simple example to see how this really works in practice. Say you invest $1,000 in a stock priced at $20 a share. That means you'll start with 50 shares. The company pays a 5% annual dividend yield, so in your first year, you'll earn about $50 in dividends. Now, instead of taking that cash out, you have DRIP turned on, the Dividend Reinvestment Plan, which means those $50 automatically buy more shares. At $20 each, that adds 2.5 new shares to your account, giving you a total of 52.5 shares by the end of the first year. When the second year starts, you're not earning dividends on the original 50 shares anymore, you're earning them on 52.5 shares. That small difference matters. With the same 5% yield, you now earn $52.50 on dividends, which buys you another 2.625 shares. You finish year 2 with 55.125 shares, and again, no extra money came out of your pocket to buy those extra shares. By the end of the third year, those 55.125 shares are now generating about $55 in dividends, which reinvest into another 2.75 shares, bringing you to roughly 58 shares in total. In just 3 years, your ownership quietly grew from 50 to nearly 58 shares without adding a single new dollar. And if the stock price itself also increases, say from $20 to $25, your investment value climbs even more, from $1,000 to about $1,450. That's roughly a 45% increase just by reinvesting your dividends and letting time do its work. This is the beauty of DRIP. Your dividends don't sit idle. They become little workers that start hiring their own workers. The process feels slow at first, yes, but over time, compounding picks up speed, and eventually your money does all the heavy lifting for you. Once these pieces are set up, you've essentially built an autopilot system. Your money flows in, your investments grow, and your dividends reinvest, all while you live your life. Now, in a couple of minutes, I'll show you how to build a 5-asset dividend portfolio, automate it with dollar-cost averaging, and in the end, we'll see how compounding can turn that simple $5 daily habit into a $1.2 million portfolio that pays over $10,000 a month in dividends. But first, let's cover step 3, probably the most important one of them all. It's about making sure you can spot the warning signs, because not every dividend stock is as safe as it looks. Here's the truth most people never hear when they start investing for dividends. Not every big yield is a good thing. Some of the highest paying stocks out there are like shiny apples with worms inside. They look great from far away, but take one bite and you'll wish you hadn't. So before you ever hit buy, let's go through a few simple checks that separate healthy dividend payers from dangerous ones. First, let's talk about the number everyone loves to chase, the dividend yield. It looks tempting when you see 8% or 10% next to a company's name, right? But sometimes that high yield is a warning, not a reward. A yield can actually shoot up simply because the stock price has dropped hard. If a company's share price falls 40%, the yield automatically looks huge, even if the business itself is struggling. In that case, the dividend might be living on borrowed time. So the first red flag is a yield that suddenly spikes for no clear reason. Ask yourself, why is this company paying so much more than everyone else in its industry? If you can't find a solid answer, that's usually the answer. It's not safe. Next is something called the payout ratio, which simply shows what percentage of a company's profits are paid out as dividends. For example, if a company earns $1 per share and pays out 40 cents of that as a dividend, that is a 40% payout ratio. It means the company is keeping the other 60% to reinvest, pay down debt, or save for slower years, and that's a healthy balance. But if a company pays out 90 cents of every dollar it earns, that is a 90% payout ratio, and that can be risky. There's not much left for the company to grow or emergencies, so if profits drop, the company might have to cut the dividend. As a general rule, a healthy payout ratio is below 70%. That gives the company enough breathing room to handle ups and downs, keep growing, and still reward shareholders with steady, reliable dividends. The third thing to check is consistency. A business that's paid and raised its dividends steadily for years tells you something about its discipline. You can easily look up a 5 or 10-year dividend history on any finance site. If you see a smooth, gradual climb, that's a great sign. If you see cuts, pauses, or big jumps followed by silence, that is a red flag. Reliable dividend payers act more like metronomes than fireworks. Another quick test: skim the company's debt and headlines. If you keep seeing phrases like refinancing debt, liquidity crunch, or restructuring, that's your cue to slow down. Heavy debt can squeeze out the room to pay dividends when business slows. Let's put that all together in one easy mental model I call the safety triangle. Every solid dividend company should have 3 strong sides. Corner 1, steady earnings and cash flow. The money has to exist before it's shared. Corner 2, manageable debt. Not too much, and interest payments comfortably covered. Corner 3, a history of steady or rising dividends, proof that the company treats shareholders consistently. If all 3 corners of that triangle are solid, odds are you're looking at a healthy payer. If one corner is weak, think twice. And remember, you don't have to be a financial detective. Most of this info is visible in just a few clicks: dividend history, payout ratio, earnings trend, and debt levels. Once you've checked those boxes, the rest comes down to common sense. Does the company's business model make sense to you? Could you explain how they make money to a friend in one sentence? If not, skip it. Confusion is a risk. Okay, so now that you know how to spot strong, reliable dividend payers, it's time to put that knowledge to work and actually build your portfolio. This is where everything starts coming together, turning what you've learned into a simple, balanced income system. I'm going to keep this simple but powerful. 5 assets, equally weighted, that's it. No endless watch lists, no complicated trading, just 5 high-quality pieces that work together. Think of your portfolio as having 2 layers, a core and a satellite. The core is your foundation, which gives you stability and a steady income. The satellites are your boosters, which add a bit more growth and higher dividends. Together, they create a balanced setup that's easy to manage and designed to keep your income growing over time. So let's start with the core of your portfolio. The first piece is SCHD, the Schwab U.S. Dividend Equity ETF. It currently has a 3.77% dividend yield, with dividends growing at an average rate of about 10.43% per year. On top of that, its share price has appreciated by around 8.23% annually over time. It holds a mix of strong American companies that generate consistent profits and have a proven record of paying and increasing dividends. With one investment, you're getting broad exposure to some of the most reliable dividend payers in the U.S. Next is VYMI, the Vanguard International High Dividend Yield ETF. This one adds a global balance to your portfolio. It offers a 3.91% dividend yield, with dividend growth averaging 11.58% per year, and its share price has grown around 3.67% annually. Because it invests in large dividend-paying companies from Europe, Asia, and other regions, it gives you exposure to global markets, making your income less dependent on how the U.S. economy performs. Together, SCHD and VYMI form the foundation of your portfolio, a stable base designed to provide steady income and wide diversification across both the U.S. and international markets. What makes this pair especially strong is that they have virtually zero overlap in their holdings. SCHD focuses entirely on U.S.-based companies, while VYMI invests only in dividend-paying companies outside the U.S. That means you're not accidentally doubling up on the same stocks or sectors. This separation is important because it keeps your portfolio balanced. When the U.S. market slows down, international markets might be doing well, and vice versa. This way, your income comes from two different markets that don't move in the same direction. Together, they give you global exposure, smoother returns, and a steadier stream of dividends through different economic cycles. Now let's add the satellites, the stocks that bring extra dividend growth and potential upside. The first is Morgan Stanley. It currently pays a 2.54% dividend yield, but what makes it stand out is its incredible 22.4% dividend growth rate. Its share price has also grown by about 17.15% a year, showing just how strong its business really is. Morgan Stanley's steady wealth management division and careful balance sheet make its dividend both sustainable and fast-growing. Next is Rexford Industrial Realty, a real estate investment trust that focuses on industrial properties like warehouses and distribution centers. It pays a 4.13% dividend yield, grows its dividend at about 13.18% per year, and its share price has appreciated around 11.29% annually. REITs like Rexford are great for adding a consistent income stream that's backed by real assets, properties that generate rent every single month. Finally, we have T. Rowe Price Group, a long-standing investment management company known for decades of dividend growth. It currently yields 4.92%, grows those dividends at roughly 8.92% per year, and its stock price has averaged 5.87% annual growth. It's financially strong, has little debt, and is committed to returning value to shareholders year after year. With these 5 holdings, SCHD, VYMI, MS, REXR, and T. Rowe, your portfolio now covers a wide range of areas: strong American companies, international dividend payers, finance, real estate, and asset management. Each investment plays a specific role. The ETFs give you stability and consistent income, while the individual stocks add faster dividend growth and a little extra yield. Together, they create a balanced portfolio that's easy to understand and simple to manage. It's also easy to maintain. You don't have to consistently search for new ideas or worry about rebalancing every week. An equal split, about 20% in each, keeps things organized and predictable. Since all 5 investments pay dividends quarterly, you'll start to see regular income flowing into your account. So instead of guessing or trying to time the market, you now have a complete, structured plan. The next step is to calculate the portfolio's overall numbers, starting with the dividend yield. Since all 5 investments make up an equal part of the portfolio, we just take the average of their individual yields. Here's how. SCHD has a 3.77% yield. VYMI is 3.91%, MS is 2.54%, REXR is 4.13%, and T. Rowe is 4.92%. Add them together, 3.77 plus 3.91 plus 2.54 plus 4.13 plus 4.92 equals 19.27. Now we divide that total by 5 because we have 5 holdings. 19.27 divided by 5 equals 3.85%. So the portfolio's total dividend yield is 3.85%. That's really all there is to it. You can use the same simple averaging method to find the portfolio's dividend growth rate and average share price appreciation as well. When you do that, you'll get a portfolio dividend growth rate of 13.3% and a portfolio average share price appreciation of 9.24%. These 3 numbers together give you a clear snapshot of your portfolio's income, growth, and performance potential. Now let's look at what this portfolio could look like in the future. Let's say John invests $5 a day, which adds up to about $150 to $155 a month. After 1 year, John would have invested around $1,825 into the portfolio. This sets the stage for future growth. By year 10, his portfolio is projected to be around $35,572, and his reinvested dividends will already be boosting his returns. After 20 years, the portfolio will be valued at roughly $198,918. This is when the compounding snowball effect really starts to show up. And by year 30, John's portfolio is projected to reach $1,230,998. At that stage, his investments will be paying around $123,682 in annual dividends, or roughly $10,307 every month, purely from the portfolio itself. Out of that total growth, about $558,167 will come from price appreciation and another $618,081 from dividends being reinvested along the way. That adds up to a total value added of about $1,176,248. Want to know the fastest way and the investment amount you need to reach $3,300 a month in dividends? Click the video on the screen to find out.